Okay, so this is learning objective 2 on our debt investments. And what are debt securities? They are just the other side of chapter 10. In chapter 10 we issued bonds, we paid interest, and we redeemed the bonds. Now we are the company who buys the bonds off the open market. We're investing in the bonds. Investing in debt securities, we call them, or debt investments. We're going to record them as an asset because they're an investment. And we're going to be receiving interest checks, usually twice a year. And we'll be recording that as interest revenue. Okay, so who issues the bonds that we're investing in? Well, could be corporate bonds. These would be bonds issued by corporations to fund various projects, to raise money. They could be U.S. Treasury bonds. These are put out by the federal government to raise money. And those you can buy directly from the government or through a broker. Municipal bonds are another, you have municipal and other government agency bonds. Like the city of Miami might issue bonds to, build some new parks or whatever they were doing. And then other government agencies, the MBTA, bond issue for more trolley cars, that would be nice. And the ones that I find interesting in Massachusetts right now are what are called the green bonds. We have Massachusetts green bonds, and these are used to finance environmental projects. So right now they've issued some bonds to do the infrastructure in, I think it's New Bedford, for some wind power project that they want to do, and they need the infrastructure in the harbor there in order to do that project. So other things to keep in mind about bonds: they have a set maturity date when they come due, but investors can buy and sell them whenever they want on the open market. Also, our investors in bonds have no vote. So there's no possibility of control over the company that we have bonds with, okay, the investee. And we'll generally receive interest twice a year based on the face value of the bond. Okay, so let's look at this example that I have here. This is just as to do the accounting for this. We're going to buy 6% $1,000 bonds for $5,000 plus transaction fees of $100. Okay, so we start with 1-1, and we've got a debt investment. And how much is our debt investment? It's going to be what we paid plus the fee, because that was part of the transaction. Okay, and I am including those transaction costs because as an investor yourself, or if you're working for a company and you have to do the accounting for this, the fees are an essential part of accounting for this. And I cannot imagine why the book took them out, because it was in all previous editions. It makes a difference for tax purposes, because otherwise, if you did not include the fees on both ends, you would be overpaying income taxes. Okay, so debt investments, cost base, what you paid plus the fee, $5,100, cash, $5,100. On 7-1, we receive interest. So we're going to be getting an interest check, we get cash, and we're going to book interest revenue. And how much are we going to book? Well, it's going to be the face value of the bond, the $5,000 face, and this is just how we computed it before, times the stated interest rate of 6%, would give us $300 annual interest, but it's over 2 payments, so $150 is our amount. Okay, now we're going to sell 2 of our 5 bonds, on 7-1. So we're going to receive cash, because we sold it. We're going to take the debt investments off the books, just the ones we sold. And there's also probably going to be a gain or a loss on the transaction. Okay, step at a time here. How much cash did we get? Well, we sold them for $1,500, but we had to pay a fee. So we've got to take out that $50 fee. So our proceeds, what we actually get after the fees, are $1,450. Okay, $1,450. Now, the debt investments are on our books for $5,100. That's the cost base of all 5 of the ones we have. We sold 2. So to find out how much those 2 cost, we simply go 2/5 times the $5,100, and that will give us the cost base of what we sold, which comes out to 2040. So our 2 that we sold come off at 2040. This is kind of a sad situation. We only got $1,450. The cost base was this. We didn't do so well. We've got a loss on the sale of debt investments. Most of the examples in the book will always have gains, and I think that's a bad habit to get into because that's not always the case. And I wouldn't want students to think that every time you did a transaction like this, there was a gain. So every once in a while we'll do a loss. So we have a loss of $590. Okay, so the cash proceeds, it's just the amount that you received when you sold it less the fee. The debt investments come off the books at whatever percentage they are of your total holding. So in this case we sold 2/5. That's the total cost base, and this gives us the cost base of what we sold. Okay, in the notes I also have a second example. I redid exercise 12-2, except with the transaction fees. And rather than go through all of that, which is really just what we did here, I'll let you take a look at that and let me know if you have any questions on it. Okay, and so that's about it for the cost base, the cost method of doing our debt investments.